For those of you who would like to open a brokerage account, you'd like to buy shares and you don't know really, you haven't done that before, or you're just looking to get started, or maybe you have a brokerage account but you're not really happy with them, or maybe you want another one, there's a link below in this video to Robinhood, and if you use the link provided below, when you sign up with them, you can do it on your phone or on your computer, they will give you one free share just for signing up. There are no fees, there are no required amounts deposited to use the account, and they do not charge you a commission to buy or sell, whether 1 share or 1,000 shares. So it's a really cool feature. They will also give me one free share simply for referring you if you use that link below. So it's a win-win. Afternoon everybody, Christian here. Today I'm going to share some little story with you that happened recently regarding investing for my daughter. So she, as you guys know, she's joining the Army, and I'm a proud dad. And this means that she's going off to basic training in AIT. But this also means that she's not going to be here for me to, kind of train her up in finance and things like that. So I had to come up with a solution for this problem. Obviously my daughter, she's going to have money and she's going to save and invest some of that money. But how do you do that if you don't have all of this knowledge? And if you're going to go out and analyze individual companies, you have to have the knowledge so that you can do that. And that means putting in many hours to come up with the knowledge required to accurately analyze individual companies. Well, Warren Buffett and Benjamin Graham, Warren Buffett's teacher, they came up with one solution for the problem. And that solution was, if you're not going to spend the time, or you don't have the time to put into educating yourself and researching companies and following those companies, what you can do instead is go out and simply buy some fund that simply tracks the major market average. So in this case, we'll use the S&P 500. If you want to invest and you have no knowledge and you don't want to gain any knowledge, you don't have the time or whatever, you could go out and just make a consistent investment into the S&P 500 over the long term. Every single month you'd make a certain amount of money and you invest that money into the stock market. And when it was high, you'd buy fewer shares, and when it was low, you'd buy more shares, and you just get an average price that you would pay. And you would not outperform the stock market, but you wouldn't underperform all that much either, because you would just be basically tracking the market. And of course you have to watch out for fees, because that could cost you. Certain funds charge a certain amount to manage that fund, and therefore you would kind of underperform the S&P 500 by that amount. So the lower the fee, the better. So you might get into something like the SPY, and you probably get a dividend yield of, right now it's roughly about 1.8, 1.9%. And that's where I have a problem with it, because I am really into dividends. I think dividends are awesome. I love the fact that an investor can go out and buy a company, and that company pays a dividend. They will take a portion of the earnings from that company, and they will, quarterly or monthly or biannually, however the company chooses to do it, they will pay a portion of the earnings out to shareholders, to the investors, in the form of a dividend. And that dividend can be used to either buy more of this company, and therefore increasing the dividend that's paid out next time, or buying other companies. And over time, as you build this portfolio of dividend companies that pay dividends, you are growing that cash flow, or stream of cash flow, that's allowing you to do more and more. Some people choose to use that money to pay bills, etc., etc. For me, when I look at the S&P 500 paying under 2% yield, I'm not impressed. And the reason that it pays such a small amount is that not every company in the S&P 500 pays a dividend. So those that do pay a dividend are being watered down by those that don't. And so I was trying to find a solution that I could give for my daughter, or give to my daughter, that would help her deal with the fact that she doesn't have the knowledge base that I think she needs to be selective and pick individual companies, but would also kind of steer her towards dividend paying companies. And so this is the solution that I came up with, that I gave to her and my wife, and now I'm giving to you, and something you might look into. And that is simply to go and do a Google search for Dividend Aristocrats. And this is a list of companies that you will find online. I think they actually have a sheet or a page dedicated to the concept on Wikipedia, and I'll link it below. And you go there and you'll find this list. I think right now it's like 56 different companies. And these companies are companies within the S&P 500. Obviously, it's not all the companies within the S&P 500, but they are companies within the S&P 500 that also pay a dividend and have consistently paid a dividend and consistently grown that dividend, I think, over the last 25 years. So many years of consistently growing a dividend, consistently paying a dividend, and again, they're companies within the S&P 500, so they're not small cap companies that you've never heard of. So being a larger cap or mid cap gives you the benefit that they don't have a single service or a single product that their business is relying on. They're growing, they're more mature, and they have business in various different parts of the world. Their income was going to be more diversified, and therefore the investor's income would be more diversified and safer, theoretically. So that was the main thing that I presented to my daughter. So when you're off, you're living your life and you're looking to invest, go look at the Dividend Aristocrat list and simply sort them by those that are paying the higher dividend. So you have the highest dividend at the top and you move on down to the lowest. And then start at the top and work your way down and just read up on the company and see what's going on. And if you are going to go shopping for great companies, start there. That's a shopping list to work from. I think you would avoid a lot of the errors that people make initially when they go out looking to buy companies, and by simply going and shopping off of that list. Now, it doesn't mean that every company that's on that list is bulletproof. They do say that those companies on that list are considered to be immune to recessions. However, there are companies that have been on that list and been removed from that list because they've cut their dividend, or their company started to get into trouble and they had to cut their dividend and things like that. So they get automatically removed from that list, or maybe they get kicked off the S&P 500, and so then they would fall off of that list as well. So it can happen. There's one in particular. CenturyLink is the local phone company in my area, and so I know the company, and it used to be on that list. Right now it pays like a 7.8% yield or somewhere in that range, and it's been even higher than that recently. The thing to understand is that there are things that are known as a yield trap, and it's simply a value trap, something where you'll see a high yield on a stock, and so you'll think, oh great, I'll buy this company, it'll pay me 10% every single year or whatever, that's awesome. But you'll find oftentimes situations that those high yields are actually because the company itself is in trouble, so the stock price is falling, and because the way a yield works, it just makes the yield look bigger. But if the company's in trouble, it oftentimes can't afford to pay that yield, that dividend, so they'll end up cutting it, and then cutting it again, and cutting it again, until they may simply remove the dividend altogether. Now, sometimes companies get in situations like that where they sell off massively, the yield gets really big, and the company comes back. But you have to know, you have to have some reason for anticipating that turnaround that's going to work, because lots of times it just doesn't. So I would just keep that in mind. It's just because it's on this Aristocrat list doesn't necessarily make it bulletproof. And so, of course, you want to diversify in that list, and that's probably going to be one of the biggest elements for my daughter. If you are out there and you're looking to invest for yourself, consider the fact that there are things you simply do not know. And so if you're not willing to use the wisdom of diversifying across multiple companies and multiple industries, you're probably setting yourself up for trouble.